Good morning. On behalf of the Independent Institute and the International Center for Law and Economics and the WIAA Education and Research Foundation, welcome to our conference. You know, as I was thinking about what we're going to do today, I was reminded of a famous scene in The Music Man. Now, there may not be too many of you who remember the musical The Music Man, but in The Music Man, the setting was River City, Iowa. And Robert Preston was a kind of a rogue, a lovable, flim-flam man, traveling salesman. And he gets into River City, and he wants to sell them stuff. And so he's looking around trying to figure out what he can have as a bad thing they need to eliminate so they can form a marching band. And sure enough, that day, they installed a pool table. And so Robert Preston, in a very famous scene, said, "Folks, you got trouble here in River City. Trouble with a capital T, and that rhymes with P, and that stands for pool." He then went on to tell all of the evils of pool and how it was going to just really ruin their husbands and their young children. Well, as you know, River City, Iowa was a fictional town. The real River City is Sacramento, California. All you have to do is look out the back under the Yellow Bridge and you'll see the river. And I was thinking, what would Robert Preston say if he was here today? "Folks, you got trouble here in River City. Trouble with the capital T. That rhymes with P, and P stands for Prop 103. Yeah, that was pretty cool. My wife liked it too. This morning, I also want to recall an interesting quote by Commissioner Lara on May 14th. "Californians definitely in an insurance crisis, one that has been decades in the making." He went on to say that his predecessors, Garamendi, Jones, and Poizner, were essentially incompetent, and that they were now armchair quarterbacks criticizing him as he was left to clean up the mess. Well, he doesn't mention maybe some of the mess that he created. So what we're going to do today is our speakers are going to discuss the origins of Prop 103, how it came about, what Prop 103 really is, what the elements of Prop 103 are, how it was implemented, and yes, about the terrible result from Prop 103. But more importantly, we're going to end today with a recommendation of how to fix it. In your program, we have the speaker bios, so we're not going to spend any time going over lengthy bios and introductions to the speakers. We're just going to introduce the speakers. And Karl, with the Susman Agency, you're on.
Thank you, Alan. So hopefully this is working. You can hear me okay? Maybe more than you want. I'll start out by telling you I'm sorry that on this side you're stuck with not my good side, or maybe it's that side. I think the sides are equally bad, so it's fair. So again, I'm Karl Susman. I'm going to start out today and we're going to go over some issues with Proposition 103, but specifically I want to start out with what's probably on most of our minds, which is the wildfires that have recently happened. So beforehand, I just want to give you a little bit of an idea of who it is that I am and why I'm here, why they chose me. Clearly, it's because of my bubbly personality, but I'm an insurance agency owner for about 30 years, an insurance expert witness in complex litigation. I comment in the media whenever they'll hear me, had a talk radio show host, and also write a weekly article in Kiplinger.com, which is an industry-known insurance organization, and talk about, you guessed it, all sorts of insurance-related things. So I want to start out talking about the wildfires. Everyone knows about them, right? I mean, we're in Northern Cal, but it's impossible for you not to have heard about it. But here's some stats you might not have been aware of, and certainly for some reason did not make front page news like it probably should have. Did you know that more than 30 people died? We're always stuck on the, oh, how many structures and how many acres burned and things. People died. On top of the people that died, there were more than a dozen people missing. Some still are. Over 180,000 people at the height of the fires had to evacuate. 180,000 people had to grab everything that they could hold, get it in their car, and get away because they didn't know if their home was going to be there or not. Some more statistics. Do you know that during the fire, 1 in 10 homes was uninsured? Uninsured, meaning no insurance. You hear a lot about underinsurance, right? I'm sure that will be getting litigated from this fire till my grandkids have grandkids. But there were 1 in 10 homes that they estimate had no fire insurance at all. People complained about prices of insurance. Try and have a loss without insurance. 1 in 10 people did. In addition, there were crews from 9 states that came to help fight the fires. 1,400 fire engines, 84 aircraft. It was monumental. If they didn't take some footage for some movie day someday to be able to show, you're never going to get footage like that again. The impact of the fires. Now, this fire lasted 28 days. Now, having been born in California and raised in California, I know wildfires. They start, you hear about it, and then you slowly hear about the containment starting to happen. And then it goes down pretty quickly, and then you start saying, oh, okay, it'll be all right now. They're dealing with it. That didn't happen with this fire. Days and days and days went by. This fire kept burning, and the containment sat at 0. That doesn't happen. That's not normal. That's not wildfire behavior. These are just some numbers I put in there for you. Again, I don't like to focus so much on how many acres burned. It's more about the lives that are lost. And finally, if you have to have a number, the estimate right now is somewhere around 18,000 structures were lost. 1,000. Someone had said, I think it was a professor back in college, that we can process as people up to about 100, and anything over 100 is just a big number somewhere. But try and imagine 18,000 people not having their home. One, another person, and another, and another. 18,000. This was, again, I can't even process it. Personal impact for me, of my agency alone, our office had 141 total loss clients. That means they woke up in the morning to a home, they left, and never went back. Spoke to clients that were calling us and asking what to do. Everything from, I have a toenail. What? I have to go buy a toenail clipper. Can I do that? I mean, it's this level of when you have 0 left to start from. That was 141 of our clients. Another 50 or so had partial losses. Partial losses in some ways were actually more difficult. They're still being dealt with. We have issues with smoke damage. We've all heard about it. It's still going on. We had to evacuate our own home. I live in Brentwood. Our office had to be evacuated. And we worked for the first 30 days, our entire team, around the clock. So we were available by email, by phone. People were calling, they were texting, they were panicking, they didn't know what to do. And we were there. We were giving the promise. That's, I feel, what we're here for. It's not for the $10,000 water damage because you left the sink on, right? It's for when you lose your home. And we were there to try and help our clients. So how did this impact my job? Well, I think what's important for you to know is what exactly is my job as an insurance broker. So I had to look it up to get it just right, which, fun fact, everything I'm telling you today, fact check it. Go ahead, because I did. I'm not giving you opinions on any of this. I'm just giving you facts. And that's important. So feel free. An insurance broker, by definition, I'm getting closer because I do refuse to start wearing glasses, is a professional who acts as an intermediary between individuals or businesses and insurance companies. They help clients find the best insurance policies to meet their specific needs and budgets by representing clients' interests. Focus on that last part. I represent clients' interests. What makes it interesting for me is because of what I do, I deal with the client. I hear what they have to say. I hear their experience, what they need. I also talk to the insurance companies. I talk to the insurance executives. They tell me about their woes and their issues and their problems, what's keeping their products from being available, what's changing prices, what's happening with that. I talk to people in the media that are interviewing consumers. We've all seen the stories of the people that have lost everything or people that are having problems with claims. So I'm talking to those people as well. I also do some consulting for people on the Hill. They'll ask me, what about this bill? What does this look like? What do you think the impact on this might be? So this is what we do. We start out, we talk to a client, and the client says, hey, this is the house I'm buying. And of course, we're already shocked because they're in California. Wow, okay, congrats. You found it. You made a way to do it. And what is it that you need? Well, you need fire insurance. Maybe you need flood insurance. Maybe you're going to need earthquake insurance. Maybe you have your cars you're going to insure. We go through the whole process. We put it all together, and then we go to market. And we go to our bookshelf of insurance companies, and we say, okay, which insurance company is going to give us the best package, the best coverage, the most comprehensive policies for the price that this consumer is comfortable with? And it used to be a pretty full bookshelf, right? We could use one or two programs, and it would go out to the different insurance carriers, and we would be able to get the rate, and then we could compare coverages, go back and forth with the client. But over the last, I would say, 10 years, really, there has been this steady decline of books coming out of the bookshelf and companies that are not offering coverage. And this is pretty much our bookshelf right now. And it's not hyperbole for me to say that there is no property insurance market right now. Because if you compare it to the way it was before, or you compare it to the way it is in any other state, we got nothing. We literally have nothing. Why did this happen? Well, as promised, let's touch a little bit on Proposition 103. Now, for perspective, Proposition 103 has been around since fax machines. And I actually had a call from someone a couple of weeks ago. I think it was an escrow, and they asked if I could fax over proof of insurance on a policy. I said, I'm sorry, I can't do that from where I am. And she said, well, where are you? I said, 2025. I'm in 2025. We don't fax. True story. But our insurance regulations are stuck in the fax years because the laws that are still governing what an insurance company can do, what they can't do, what they can charge, where they can write coverage, how much they can offer for a discount, are still being guided specifically by this regulation, the fax regulation. We should really give it a new nickname. Now, did you know that Proposition 103 is not just about your home? It's not. Of course, it is impacting your home insurance. It's also impacting landlord insurance. This is for people that rent their home, right? Investors, right? We like these people. It's going to impact people that rent, that have renters policies. It's going to impact condominium insurance. And guess what? Auto. Exactly. I heard the murmur. Where's my brethren? Yes, auto insurance. Okay? You don't hear about this, and I think you're going to look at it in a completely different way in about 2 minutes, because I gave you this quick example. We have two drivers. Driver one has 3 speeding tickets, 5 car accidents, 1 car accident where they killed someone. It happens. 3 tickets for illegal lane change, 2 tickets for running a stop sign. This is none of you, I hope. If it is, please leave far before I do. These drivers do exist. And let's compare them with driver number 2, which has never had a ticket or an accident. Now, if you're an insurance company, who would you prefer insuring, starting with that? You'd probably want driver 2, right? Well, according to Proposition 103, when it was passed, that after 3 years, these drivers get the same California Good Driver discount. They get the same price in 3 years. 3 years, that's it. What do you think that's doing to people's driving habits? Do you think that that's impacting how safe people are driving? Do you think that that's impacting how many people survive car accidents? Is there genuinely an argument to be made that there's blood on the road that wouldn't be there without that free pass every 3 years? I think so. It rewards bad drivers. And again, if you're a business and you can only charge, and you have to charge the same rate for those two drivers, are you going to charge a high rate or a low rate? You charge a higher rate. You have to. So the good drivers are subsidizing the bad drivers. It has to be. There's no way to do it. This is also why in that 3-year window, look out for those prices, because the carriers can only surcharge them for that 3-year period as well. So you know what those rates look like for those drivers in that 3-year period? It's not pretty. But don't worry, because in 3 years, they're a California good driver again, just like all of us that have never had a ticket or accident. The impact on driver habits, I can't underestimate, because I think it really, really is significant. And we don't think about it. How many of you, be honest, when you hear Proposition 103, you think about car insurance? Probably just the brokers. But, right, that was how it was passed. Proposition 103 passed with one simple tagline: we'll give you 20% off your auto insurance premium. Well, who's not going to vote for that? And if that was all that it did, we wouldn't be sitting here right now, right? Now, you hear about home insurance. So what does Proposition 103 do to home insurance? Let's talk about that. 2 homes again. One is at the top of a hill. There's a small little snake road to get up there. You know, forget a fire truck ever getting up that road, but it's up there. Zip code 95830, which I think is around here, if I did it right. They've got a few claims, but, you know, claims can happen. No fire hydrant in sight. Forget about that. And now let's look at the comparable home, right? They're at the bottom of the hill. They have a burglar alarm. They have a smoke alarm. They have a fire alarm. They're in the same zip code. They've never had a claim. And there's a fire hydrant at the bottom of the driveway. Can you guess where we're going to go with this one, too? Well, according to Proposition 103, these are the same risks. Okay, I'll give you 1 or 2% for the smoke alarm discounts. All right? It's not significant. You're going to be paying the same rate, even though we can, our logical brains can very clearly see that, oh, well, that doesn't make sense. So is there any incentive for an insurance company to write the first risk or anything even close to it if they have to charge the same price as the one that was the second one? Would you, if it was your money? Now, what this has caused is why we're here. The insurance market is basically dried up. 7 out of the 12 of the top carriers have stopped writing and started non-renewing. The name brand carriers, the non-name brand carriers, you name it, they're non-renewing. They're not writing new policies. Fewer options means higher prices, lower coverage. People are running to the FAIR Plan. You've heard about this, right? FAIR Plan was designed to be a place to go for specific risks that could not get coverage in the primary market. Key there, primary market, meaning that there was a place to go first. And when you couldn't find coverage, then you would go there. Well, as you remember my bookshelf, there's no market. So everyone is running to the FAIR Plan right now. They've more than doubled in size in the last 5 years. It is basic hazard insurance. It is not a homeowner's policy. Again, FAIR Plan is not a homeowner's policy. It is fire coverage. It's not going to pay if the pipe breaks. It's not going to pay if somebody breaks into the house. This is fire only. And by the way, it's really expensive. And of all of the claims that our office is dealing with, I would say 9.5 out of 10 of them are FAIR Plan claim problems. You're probably aware there was some recent litigation that went through that told the FAIR Plan they had to basically roll up their sleeves and start playing with the same rules that every other insurance company is playing with and start dealing with some of these smoke damage claims. So you think, well, with no companies writing and all these carriers non-renewing, there's a great opportunity, right? Where there's big potential exposure, there's opportunity. Well, not really, because in California, Who's going to bring their business here? What insurance company when we have such unpredictability? We have 10 bills up the street right now that are being discussed that will impact the homeowners insurance market. 10. I've talked to probably all but one or two of the sponsors. Their hearts are in the right place. I get it, right? The idea is to try and make things easier for consumers after a claim. Who wouldn't want to do that, right? We want to make things easier. The problem, of course, is that you have to have a policy first in order to then have the process be easier. So if there's no policy, you can regulate all you want, but there's nothing to regulate, right? That's where we are. There is no product to be regulated at this point. Consumer choice has plummeted. I see it every day. It's what I do. If we used to be able to have 20 companies to go to, 30 companies to go to, and now we have 0, or one of them might say, "Psst, if you see a really good house, we'll give you 1 this month." And we're excited about that. There used to be a time when someone would be referred to our office to purchase insurance that we would be excited. And now it's just a deep sigh because we have to try and figure out how we can help them. Now, this is Proposition 103. This is the most important thing I'm going to say. If you have listened to nothing that I've said, which would be so sad, but if you haven't, listen to this and take this away. Nothing else matters if you take nothing else away. Proposition 103 has a few people, one person, that will stand up and scream to the clouds that Proposition 103 has saved Californians money since enacted. Billions even, they make the claim. Have you heard it? Have you heard this? Well, that's quite a claim. So let's talk about it. How did that happen? How did we do it? How does it do that? Well, we can't talk about it because as it turns out, if you just do some math, it hasn't happened. I know that's a bold claim, but I have a few more slides, and then you'll understand why. If there was another California, which is, mind you, the 4th largest economy on the planet, where 30 years ago, Proposition 103 did not pass. So during the last 30 years, we had more companies flooding into California and writing insurance policies and competing, coming up with new products that they can write, competing for good clients, competing for bad clients, charging rates that make sense where they are, differentiating between those two houses, differentiating between those two cars and those drivers for 30 years, then we could probably have a conversation and compare. But unless you're into the multiple universe concept, we can't do that. So all we can do is focus on what we can see today. What's in front of us? What can we actually measure? Well, what we know for sure is that right now this is the worst insurance market in California history. Period. No one's going to argue with that. You're not going to find an insurance commissioner that argues. You're not going to find a politician that's going to argue. You're not going to find a consumer for sure that's going to argue. I don't think anybody in the media that's covering stories about this is going to argue. This has never been as bad as it is today. We can measure that because we can also see that there's less coverage for consumers. They're getting less coverage than they ever did before, and they're paying more than they ever did before. Again, not my opinion. This is all what we can measure. We can measure this. We can see this as a fact. We're here talking about it. Hello? If that's not reason enough that we've got a serious problem, you got up this morning and came here to hear about this. You get it. This is a serious problem. It's not that we're going to go over this tipping point. We've fallen. We're Wile E. Coyote. We've gone over and we've hit the ground. People just don't realize it just yet. The only thing that we can be 100% certain of is that the current insurance market in California exists with Proposition 103 being the law that guides everything an insurance company does for the last 30 years. We can measure that. We know that's true, right? We're on the same page with that, right? We all agree that this proposition has been the law for 30 years, and here we are. It boggles my mind how audacious it is actually for some of the people that claim to support this proposition that they can support this law. It's been the law on the books for 30 years. The market is crashed and gone, and they'll stand up and scream, "It's not our fault. It's your law. It's the guiding principle for every decision an insurance company makes. Of course it's responsible for what's going on. It's the law. It's what everyone follows." So to wrap it all up, we're there. We're at that point. It's not going to get any better. If we keep doing the same thing, we keep trying to put a Band-Aid on everything that goes on, and we try and say, oh, let's make it easier when people file a claim. Or, oh, let's not let independent adjusters make more than 10 or 15%. Or all these things that you're hearing about that's going on right now in the legislature. That's all great. We can talk about it. We can debate it. They're probably all going to pass because we're in California. Everything that appears pro-consumer passes. But there's no insurance market. There will be no claims to file. There's not going to be a need to make an inventory list for your contents because you won't have a policy with contents. We have to make a change. Californians deserve better. I'm born here. I'm raised here. I want it to be better here. We are the 4th largest economy on the planet. Companies should be fighting to get here. We have so much opportunity. We need to stand up and make sure our voices are heard and do what needs to be done. And don't let anyone tell you that, oh, we can't change Proposition 103, because I've seen an awful lot of things in this world in the last decade that I never thought could happen. And not only have they happened, they can happen with the signature by someone. We've got plenty of folks on the Hill. We've got plenty of people that we all know that if they wanted to make this change, they could change it tomorrow. Thank you.
Karl, thank you for that uplifting report. I just got a call from Robert Preston. He said, "To heck with Sacramento, I'm out of here. I'm going to Modesto." I don't blame him. Our next speaker is Christian Forrest with the Independent Institute. Welcome, Christian.
Do you have the clicker? Clicker for the slides? Clicker. Hello, everybody. My name is Christian Forrest, and I'm a research fellow at the Independent Institute, where my research focuses on public policy and economics, with a specific emphasis on government waste in California. So it's a pleasure to be with you today, but at the same time, I wish that I didn't have to be with you today. I wish that we had a state in which the insurance regulatory system was functional, eliminating the need for this conference to begin with, but unfortunately, we do not live in such a world, and hence we have this presentation. So I'm the author of the recently published policy report, How California's Homeowners Insurance homeowners insurance market collapsed and how to fix it. And as previously mentioned, many of the major insurers in the state, 7 out of the top 10, have paused or restricted new business. The FAIR Plan, California's insurer of last resort, is being overwhelmed. More and more people, especially in the high-risk areas, are moving to the FAIR Plan. The policyholder surplus of State Farm General, the largest insurer in the state, has declined from $4 billion in 2016 to a mere $1 billion. And Proposition 103, which I'm going to get into, is a very complex and multifaceted issue. Usually when you're discussing a logical argument, you can go from A to B to C. The problem with Proposition 103 is the way I want you to imagine it is it's almost like a river that goes into an ocean. So the river goes into the ocean, and it's not A to B to C. It's all of a sudden all these things are affecting the insurance market at the same time. You have the regulatory rate suppression. You have the wait times. You have the delays. You have the fact that you cannot raise your rates more than 6.9% without a hearing. So this is a very multifaceted issue. So I'm going to take it slowly and go over all the variables that created the mess that we have in California. So going back to the issue in California, between 2012 and 2021, the average underwriting profit in California was negative 13% compared to the national average of 1% over a, what would that be? Over a 9-year period. So to talk about what the insurance companies have done, their actions are listed on this document, which may be a little bit hard to read, but you can see that the stated reasons for leaving for many of these major insurance companies, USAA, expected rate inadequacy, Chubb, inability to achieve adequate price for their risk and not by a small amount. State Farm General, the largest insurer, rapidly growing catastrophe exposure, construction costs outpacing inflation, and a challenging reinsurance market. So when you look at all these companies combined, as Karl mentioned, his bookshelf is empty. Many of the major companies have left, and Californians are running out of options. I remember reading an article, I think it was for ABC, where they were interviewing some people who had lost coverage due to insurance, and they said the problem in California is not of pricing, it's of availability. So when there's no options left, consumers become like a lot more logical. They think, wait a minute, what is insurance? Maybe there's something going on, because otherwise, like, I have money, I'm willing to pay, why can I not get it? And there's a reason for it, and as we know, the reason is Proposition 103. So going back to the FAIR Plan, the number of FAIR policies has doubled. The numbers of FAIR Plan policies for residential properties has, since 2020 to 2024, has more than doubled. The percentage of FAIR Plan policies relative to total residential insurance policies has grown year over year, and it'll probably continue to grow. And as Karl mentioned, the FAIR Plan is not subject to Proposition 103, and their premiums are much, much higher than what the average premium in the state is. I believe the FAIR Plan probably costs $4,000 to $5,000 per year, and a lot of that is only for wildfire coverage. This is especially true at the top 10 counties with wildfire risk, as you can imagine, where the insurance companies have been forced to withdraw from. And the plan's losses from the LA wildfires have already been substantial. And according to California law, insurance companies, licensed insurers in the state, are responsible for FAIR Plan losses. So there has already been a $1 billion assessment from FAIR Plan losses, and these losses are going to be passed on to the average consumer. So going back to Prop 103, why was Proposition 103 passed? That's something that people have asked me. They assume that, oh, there must have been a good reason to implement this, otherwise voters wouldn't have voted for it. The first thing is, I don't want to call it political bribery, but as mentioned earlier, it was a 20% reduction in then auto rates. So if voters see that they're going to get a 20% discount, of course they're going to vote for something. It's in consumer self-interest. But more importantly, when I read through the voter guide for Proposition 103, the primary overwhelming emphasis was on auto insurance. So when you look at all the discussions, you can see, keep big government out of the auto insurance business. I think is this the one by Harvey? No. But you can see drunk drivers, they're all talking about drivers. The proposition, of course, did mention property and casualty insurance, but it was really a side note. So as mentioned previously, I do not think when voters implemented Proposition 103 that they would ever expect the magnitude of consequences that we've experienced today. And by the way, the proposition passed with a very narrow margin. Only 51% of people approved it. So when only 51% of people support something that perhaps they don't even understand the full consequences of, and years later, it has absolutely wrecked an entire industry, you have a serious problem on your hands. So critical historical context, as I mentioned, it was primarily sold as an auto initiative. The author of Proposition 103, Harvey Rosenfield, has benefited, I won't say profited because Consumer Watchdog, the consumer advocacy organization, is a nonprofit, has benefited immensely from Proposition 103, which effectively created a niche sort of law through consumer intervention. And a 2024 LA Times article reveals that in the decade prior to the article, Consumer Watchdog collected more than $11 million in consumer intervention fees, because one of the things that Proposition 103 does is that it allows consumers and their representatives to challenge rate filings and to recover fees and expenses. So Harvey Rosenfield, the author of this proposition, ends up working in the exact sort of law that he created, which is effectively creating your own niche, boutique sort of law industry. So yes, as I mentioned, Proposition 103 is very multifaceted, so please bear with me. But what it essentially does is, the first thing it does is it creates a prior approval system. When an insurance company wants to raise rates, they need to file with the insurance commissioner, the Department of Insurance, and these rates need to be approved before they're allowed to be implemented. The regulation that governs this is that rates must not be excessive, inadequate, or unfairly discriminatory, which sounds reasonable on paper, of course, right? But the truth is that Proposition 103 subjects California rates to a litany of other regulation on what exactly it means to be excessive, inadequate, or unfairly discriminatory. So, for example, in 2019, California banned the use of gender as an auto rating factor in auto insurance, meaning that you're not allowed to charge males more than females. And I'm sure that every male in the room will tell you that when you were 16 years old, 17 years old, you were probably a reckless driver. I know that over the past 10 years, my driving habits have certainly changed. So the truth is, the basic truth of economics is that there's no such thing as a free lunch. So when you exclude the use of relevant variables, someone has to pay for it. So in the example of California, what happened is when they banned gender as an auto rating factor, women ended up paying more and males ended up paying less, but it was approximately the same amount of money. So the bad behavior of males in driving was directly compensated for their female counterparts. So as I mentioned, it allows it created the consumer intervener process where consumers and their advocacy groups, like consumer watchdogs supposedly, are allowed to challenge rates and recover fees. It allows the insurance commissioner to challenge rate filings via hearing. Hearings are also triggered when rates exceed 6.9%. And I was curious because that 6.9% does not seem like a lot in an inflationary environment. I was curious, how burdensome are hearings on insurance companies? So I reached out to the Ombudsman of the Department of Insurance. The Ombudsman informed me that in the past decade, probably prior to the State Farm hearing recently, there had only been one hearing. So hearings are such a regulatory burden that companies will do everything in their power to avoid hearings. So this 6.9% is effectively a legal cap on the amount which insurance companies are able to raise their rates by. As I mentioned, it subjects insurance rates to a litany of other regulations which are found in Title 10, Chapter 5 of the California Code of Regulations. So going to the rate inadequacy that we're experiencing in the state. Insurance markets function properly when insurers are allowed to charge a premium that directly reflects their long-term expected average costs plus a normal rate of return on capital for the shareholders or policyholders, depending on whether it's a for-profit or mutual insurance company. Regulatory rate suppression, on the other hand, is the difference between these rates that are actuarially sound, those that are priced in accordance with risk and real expected cost. According to research by the International Center for Law and Economics, California has the worst regulatory rate suppression in the nation for both home and auto insurance, the worst in the entire nation. Even though we're the largest residential insurance market, we have the worst rate suppression. So on one hand, as Karl mentioned, if people had the ability to do business in California, they would love to do so. There are so many consumers here. It is ripe for opportunity, but we have the worst regulatory rate suppression in the nation. According to the president of the FAIR Plan, which is not subject to Proposition 103, but is still subject for department rate approval, the plan had a rate need of 70% in 2022. They didn't think that was realistic. They didn't think they were going to get it. So they instead applied for a rate change of 48.8%. They were ultimately only approved for a 15.7% rate increase. So what is that? That's about a fifth of the actuarial rate need that they had at the time. And if these are the rates that are being approved for the FAIR Plan, you can only imagine how actual other licensed insurance companies are faring. And the recent emergency rate hike that State Farm was recently approved for is proof that there's rate inadequacy in the state. The fact that even the department concedes that California's in a crisis and there's a need for emergency rate increases, that is a confession that our system is flawed. So yes, breaking down the cause, as I mentioned, you cannot raise rates more than 6.9% without a hearing, which implements an effective legal cap. According to the California Department of Insurance, 60% of rate filings from 2017 to 2020 were between 0 and 6%, as you can imagine. One company, just to avoid a hearing, even filed 6.9%, 6 separate 6.9% rate increases in a 23-month period. And by the way, to talk about regulatory rate suppression, one of the things about California is not only can you only raise your rates by 6.9%, you're only allowed to do so. You're not allowed to request another rate increase while one is still pending. So on a normal like homeowners policy line, you're allowed to do 6.9%, wait for approval, 6.9%, 6.9%. So you can imagine in an inflationary environment, when costs are raging, when wildfire risk is surging, that this 6.9% rate increase at a time, especially when you're forced to wait, the average wait time for rate filing decisions between 2017 and 2020 was 160 days for non-intervened filings. This means theoretically the department's okay with it. They're not going to challenge it. And 337 days for intervened filings. So when you're forced to wait that extensive amount of time, months, just to raise it by 6.9%, you can imagine that over time, the difference between reality, what rates should be, and the rates that are permitted by regulators is going to become increasingly far. So under Proposition 103, rates are supposed to be deemed approved if they are not challenged by the department within 60 days of an application's notice. The reality is, as I mentioned, companies will do everything in their power to avoid a rate hearing. That means that the department has significant leverage to delay. So the deemer clause, the clause that deems rates approved within 60 days has been rendered moot because the Department of Insurance can just use the leverage that they have to request the companies waive the deemer date. And if companies do not comply, they can move to the department can move them to a hearing, which is just going to cause even more regulatory lag and rate suppression. So another issue, as I mentioned, Proposition 103 subjects California rates to a litany of regulations. Two of the most impactful were the restrictions on forward-looking catastrophe models and reinsurance costs. So forward-looking catastrophe models are essentially models that take probabilistic approaches to how wildfire risk might evolve into the future. And it's ironic that California, which claims to be a progressive state that emphasizes policies around climate change and other Gavin Newsom initiatives, it's ironic that a forward-looking state like California has an incredibly regressive approach when it comes to our approach to catastrophe modeling insurance. And reinsurance costs, which is effectively insurance for insurance companies. So when you have a huge loss event like the ones in Los Angeles, when there are thousands of structures that have been destroyed in an incredibly expensive area, companies want to prepare for that liability, and they will purchase reinsurance to prepare for massive catastrophe events like this. Previously, according to California regulations, factoring reinsurance costs into rates was prohibited, even though in a catastrophe-ridden state like California, this is an absolutely essential, crucial part of the insurance equation. Same with catastrophe modeling. So to illustrate why this is a problem about catastrophe modeling, in 2023, USAA gave different California counties a wildfire risk score threshold from 1 to 32 and said that they will only accept new policies with in areas that have a score of 1. Not a single place in California, not a single county had a score below 12. So this perfectly illustrates the economics of insurance. If you force companies to exclude relevant variables from their risk calculations, they will simply opt out of the market altogether. So when insurers are prevented from setting actuarially sound rates, incorporating all relevant risk variables, and are forced to wait months to raise their rates, often only by 6.9%, the maximum amount without a rate hearing, they cannot respond effectively to changing conditions. Among increasing wildfire risk, increasing inflation, increasing construction costs, which have outpaced inflation, by the way, eventually this is going to lead to a situation where insurers flee the state. So speaking about wildfire risk, there are two aspects to an insurance market. There are the premiums, the written premiums, and there's the underlying risk. And to solve the situation, you really need to rectify both. But I've talked about the premiums. Let's talk about the risk for a second. So wildfire risk in California over the last 2 decades has increased significantly. Even before the recent wildfires in Los Angeles, which have been incredibly destructive, we don't really even know where they rank in terms of their destructiveness now. 9 out of the top 10 biggest fires in California history have occurred since 2017. If you look at the total amount of acres that are burned per year, it's more than doubled in the last 2 decades. And while the total number of fires has decreased, the average amount of acres burned per fire has gone up significantly, which means that when wildfires in California burn, they're burning more destructively than ever before, which is going to be a problem in places like Los Angeles. And as Karl mentioned, I'm from Los Angeles. It was stunning to see the fact that these fires were at 0% containment for so long. It's like, if you can't contain these fires, they're just going to keep spreading and spreading, burning more and more. So wildfire risk has increased significantly, and insurance rates need to account for that. Oh, and also speaking about costs and loss with regards to wildfires, the average loss from 1999 to 2008 was $400 million, and this is inflation adjusted in 2018 dollars, versus 2009 to 2018, the average figure was more than $1 billion per year. So it's more than doubled. So another question is that people have asked me is, why were so few homes in Los Angeles fire resistant? You would think that people who live in such a risky area would take every effort to protect their property, their life, and everything that they hold dear to them. But the truth is that if you look at Palisades, I mean, a lot of people had dry brush in their yard. Things were not particularly fire resistant. And one of the reasons for this is the fact that we have inadequate rates in California. So when people are not paying in accordance to the risk that they are exposing insurers to, they have no incentive to implement good practices on their own property. So as Karl mentioned, right now, according to Lars regulation, there are minimal discounts if you take certain measures like putting on a fireproof roof onto your home or doing other things. But the truth is that the reason why insurers are not incentivized to give good discounts is because rates are already unsound to begin with. So if you're already not receiving enough premiums relative to the total risk that you're exposed to, of course you're not going to give one person a discount because your entire insurance model is broken. But you can imagine in a system, a free market system where rates are adequate relative to risk, that insurers would say, oh wow, you've taken all these steps. If I don't offer you a discount, my competitor is. And this is one of the most important things to understand about the insurance market. Insurance is a homogeneous good in which there is competition. Insurers primarily compete with each other on the grounds of price. And if you can prove that you are a less risky client, your competitor will see that as an opportunity to take your business away if you do not offer that person a discount. So in a free market system, people living in the risky areas, if they want homeowners insurance, they would be forced to pay for that. And if they implement good practices, they would receive discounts. Policy recommendations. So ironically, Laura, the current California Insurance Commissioner, captured the essence of the issue in 2024 when he said that by law, the insurance companies don't have to be here. And when we overregulate, we'll see what happened after the Northridge earthquake. When the legislature came and tried to overregulate, they no longer write earthquake insurance in California. When he said this, he captured the essence of one of the most famous quotes in all of economic philosophy, that it is not from the benevolence of the butcher, the brewer, the baker that we expect our dinner, but from their regard to their own self-interest. Insurance companies are companies. They do not provide, mutual insurance companies are a little bit different, but typically, insurance companies provide their services for profit, and when you take that motivation away, it is not surprising that they will leave the state in droves. So what needs to be done? The prior approval system needs to be abolished, and premiums should be set in accordance to the dynamics and principles of a well-functioning, open competition insurance market. Unfortunately, due to the fact that in the language of Proposition 103, it says that the proposition cannot be amended except to further its purposes, Proposition 103 must be put as a ballot initiative for voters to repeal. Insurance companies should be able to raise and lower their prices freely in accordance with ever-changing conditions, and they should be able to incorporate any risks that they consider relevant in their actuarial assessments. And by the way, as mentioned previously, if they incorporate variables that people don't agree are actually relevant, the consumer might know better than the companies, and they can go to the competition and say, hey, I actually don't think this is a relevant variable. You should give me a discount. And if they're right, the competitors will. So on the risk side of things, we need to mitigate wildfire risk in California. There's a few ways to do this. Fire suppression in Northern California and Southern California are very different, but regarding Northern California, California should honor its 2020 Memorandum of Understanding with the U.S. Forest Service, in which they agreed to do controlled burns on 500,000 acres of land per year, yet the state has only done 100,000 ever since, so about 20%. They should honor this commitment and prioritize wildfire prevention over wildfire suppression, because as we saw with the Los Angeles wildfires, it is way easier to prevent a wildfire from breaking out than to suppress it once it burns out. One of the reasons that the LA wildfires were so deadly is the fact that the winds were so ferocious that we couldn't get any helicopters into the air. So prevention is always going to be more effective than suppression. In Northern California especially, these controlled burns are very effective at that. Electrical equipment, I believe that I read a statistics that I think 75% of wildfires are man-caused, and of total wildfires in the U.S., I believe about 10% are caused by utility and transmission lines. So the Lahaina wildfire in Maui, that was caused by failed transmission lines. It is speculated that the Eaton fire in Altadena, California, was caused by failed transmission lines. Utility companies should implement public safety power shutoffs when there's a red flag warning. So when there's strong winds coming in, you cut the power and totally mitigate wildfire risk. So I'm from Los Angeles. I'm from the evacuation zone. My hometown is right next to Altadena. And on the night of the fire, my grandpa and I drove over to Altadena to see what was going on. We drove back to our home and the power was still on. So not only is the Altadena fire going, we could have had a La Cañada fire too. So I know from firsthand experience that the power was not cut, and this should be a huge priority among utility companies. Alternative strategies include moving power lines underground, insulating them. There's new technology that's called synchrophaser-based controls that cuts off power faster than gravity can pull power lines down. So these prevention strategies are crucial in mitigating wildfire risk in the state. Another a more counterintuitive way to mitigate wildfire risk is through the reformation of zoning laws. So California, like much of the U.S., has extensive single-family zoning. This is why when you fly over the U.S. or you fly over Los Angeles or you fly over Chicago or anywhere, you just see single-family home, single-family home, single-family home. Because unlike places in Europe or Asia, in the U.S., we had no option to build up, so developers were forced to build out instead. This eventually led to the creation of housing. It led to a drive until you qualify a market, but it eventually led to a situation in which the only places to build new homes were in high-risk wildfire areas at the bottom of the foothills. I mean, as a young person who potentially wants to own a home in California one day, I've looked at property values, right? And the only places that are even remotely affordable are places in like Siskiyou County, Humboldt County, the riskiest places in the state. So as California was development moved outwards and eventually moved to a place called the wildland urban interface. This is the zone in which nature and wildlands and vegetative fuels collides with human development. And the people may not realize how risky it is because, Los Angeles is beautiful, it's green. But the reality of the situation is that if you're living at the bottom of Angeles National Forest, that is subject to immense wildfire risk. And it's funny because my grandparents, who, as I mentioned, I'm from near Altadena, when I looked up our home on a map, it said you are in the extreme wildfire risk zone. But my grandparents are like these happy people. They've never mentioned this to me in my life. They're just living in complete ignorance of the potential dangers they might be facing. But in a system with actuarially sound insurance rates, maybe they'd have to face the reality of that situation. So if you want to read more about the situation, you can read my recently published policy report, How California's Homeowners Insurance Market Collapsed and How to Fix It. More information on our work at the Independent Institute can be found at independent.org. And questions and comments are welcome at my email, k4s@independent.org. Okay, so the project that I oversee at the Independent Institute is called the California Golden Fleece Awards, and it's a project dedicated to exposing waste, fraud, and abuse in California on the state and local level. So past Golden Fleece reports have targeted topics like the Department of Motor Vehicles, the DMV, Proposition 47. Pretty much any public failure in California is up for our Golden Fleece Awards. We do our research, we do our due diligence, and we decide how is California misusing its public resources. It's based on it draws inspiration from the National Golden Fleece Awards from the 70s and the 80s by U.S. Senator William Proxmire. And yes, so in order to earn this, a program, agency, or policy must violate common sense principles of responsible government and be considered wasteful by people of varying political philosophies. So in my recent policy report, we gave the California Golden Fleece Award to 4 recipients. Harvey Rosenfield, as the author of Proposition 103, arguably the cause of all of this, Proposition 103, the California Department of Insurance, and California Insurance Commissioners. And unfortunately, because Harvey Rosenfield and Ricardo Lara are not in this room, I will invite Alan Smith from WIAA to accept the Golden Fleece Award on behalf.
Too bad Harvey isn't here. He was invited.
So one more thing, regarding the Golden Fleece Awards project, we encourage people both inside and outside the government to send us potential candidates. If there's anything in California regarding a public agency that you think is squandering the public good, please, you can submit candidates anonymously at this link right here. Alternatively, you can also email me at k4s@independent.org. But through our work at the Independent Institute, we hope to keep advocating for sound reforms in the California government, and hopefully we can restore the California dream and make California a good place to live again. Thank you very much.
Thank you, Christian. Just one quick comment, and we'll go to a break. I think there's a conventional wisdom that Commissioner Lara has really done great work with his sustainable insurance strategy. We're very skeptical. Recently it's, gee, you can use climate models. You can pass through your reinsurance costs. Those are elements of a filing. Some of these filings are thousands of pages long. What he doesn't say is after you put all that in there, they're just new elements, I'm still not going to approve your filed rate. So we can take a break. There are great muffins out there, and let's reconvene at 10:30. Welcome back. We're going to get started now with my pleasure to introduce Lars Powell.
Well, hello, and thank you for having me. I'm Lars Powell. I'm at the University of Alabama, where I direct our Center for Risk and Insurance Research. Our center identifies and solves risk and insurance problems with research, education, and outreach. And it's probably my favorite job I've ever had because I like to talk about insurance. I like to read about insurance. I like to do research on insurance markets, as I've done for about the last 27 years. And so today I want to share a few things with you about insurance in California. A few years ago, we were approached by some folks who wanted us to write a critique of Prop 103 that uses like data and math and sound reasoning to, so it's not something you could usually do for an academic audience because we already know that this stuff is obvious. But we were able to get this paper published in the University of Connecticut Insurance Law Review, which is a high quality publication, because it was a highly salient issue. So everything I'm going to share with you, all of the evidence is in those peer-reviewed and published papers. And I think we've got some copies here. You can go to a website that Alan will tell you about at some point and download them if you'd like to see them. But today, whoops, wrong button. Okay. I want to talk about Prop 103, and I call this presentation a case study in regulatory failure. I'm not meaning that any of these individuals are failures in and of themselves, just that this is very poorly conceived and poorly executed regulation. Today, the insurance industry is beset with all kinds of actual problems. We have wildfires, hail, hurricanes. We've had reinsurance prices until this year have have gone up a lot with inflation. Now, important, none of these are insurance problems per se. Insurance is where you feel the pain. All of a sudden, and this happened after Hurricanes Ivan and Katrina in Alabama, Mississippi, Louisiana, along the Gulf Coast, the Gulf of America coast, as we call it now. And people said, wait a minute, for the last 20 years, I've been paying $800 or $900 a year for my homeowner's insurance, and now it's $2,500 a year. First of all, have you ever heard of inflation? How'd you pay the same thing for homeowner's insurance for 20 years in a row? That's got to be false. Number two, most of these companies didn't realize what exposure they even had in these areas. This was before a lot of the large carriers even had geolocated all of their houses. They just knew how much premium they were getting, how many losses they were paying out. And then all of a sudden you have 7 of the 10 most expensive hurricanes in the history of insurance since we've been recording it happen in a 14-month period. Say, hey, wait a minute, we better find a way to price this. So you feel the pain in your insurance premium, but this isn't a insurance problem. It's really a how you build your house problem, a where you put your house problem. California's problems are insurance problems. But it's not that the insurance mechanism doesn't work here, it's that insurance regulation doesn't let the insurance mechanism work here. So I took this out of one of the trade press magazines. It shows premiums and losses, or I think profits and losses for California homeowners insurance from 1991 through 2018. You can see that through 2016, it had accumulated about $10 billion in profit over about 25 years, which is probably about right. Risk reward, you would think, oh, okay, $10 billion, it's not a very large percentage of the total given how much exposure there is here. But then you had 2 years, 17 and 18, it lost on average $10 billion each year. So after just those 2 years, you've got a 27-year total profit of negative $10 billion. Well, they say, oh, that's just, that'll all average out. We'll never have big fires like that again. Why are we here? Palisades fire made those look tiny. So there's a bit of cognitive dissonance in the idea that we can just let it be. Don't do anything because it'll upset people, it'll upset the market. And so that's the first approach that we see from some state regulators. And these are tables from our paper, so the data end in 2022. I'll tell you that they would not have improved if we brought the data through. I think 2024 is now available. These are from rate filings. And this is the average days to resolution from 2018 to 2022. And California is in red. You can see Colorado took this to the extreme, an average of 420 days. This is auto insurance. This is homeowners insurance. The idea is, hey, let's just ignore it and hope it goes away. Delay, deny, stretch it out, and maybe the market will fix itself. I call this the ostrich plan. It's never worked very well for the bird. That's not a good defense right there, to stick your head in the sand. But it's what, hey, well, let's, there's this deemer provision that Christian told you about, supposed to approve, if they don't respond to a rate filing within, 30 or 60 days, it's automatically approved. But you have to, as an insurance company, you have to waive that when you submit your filing. So it's a false law. The next thing is the regulatory rate suppression, which Christian also told us about. I'm giving you some context compared to other states. This one, so California is to rate suppression what Alabama is to college football. I say that as a South Carolina Gamecock fan, so I don't really brag about football a lot. But you've got average rate suppression. This is an average over 5 years. Average rate suppression in homeowners insurance, 28%. That's the difference between what's applied for and what's approved. And for auto insurance, it's like 16%. Applied for, indicated versus approved. So what the actuary says you need versus what the regulator says you can have. I call this one the King Canute. Is anyone familiar with King Canute? He was said to be the best political leader and king of all times. I think he was like a Viking that was over the United Kingdom for some period of time. And his followers, his subjects said, "You're so powerful, I'll bet that you could command the tide not to come in, and it would stay." So they carried his throne down to the beach, and he said, "You shall not rise." The king got wet that day. And it's very similar to what happens when an executive in charge of insurance regulation says you may not let your insurance premiums go where they need to be. We insist that you lose money. There's the old joke about that between actuaries and insurance agents that they're like, hey, you lose a little bit on each transaction, but you make it up on volume. You know, that doesn't really work, right? You just lose an awful lot. But so the King Canute was, like I said, the king got wet, and so does every regulator who tries to, by fiat, demand that insurance rates stay below where they should be. Now, how do they do that in California? I'm not going to go back through all the details. I probably haven't memorized them as well as Christian has. But Prop 103 passed in 1988, and I've got you a picture of a Ford F-150 from 1988. That one was for sale on Facebook Marketplace. That is the sort of stuff that comes up in my feed because I live in Alabama and I like to fix old junk. My wife says I have a tractor problem or a tractor habit. I say it's a hobby. But, and this is a 2025 Ford F-150. One of them gets you where you want to go a lot better and a lot more comfortably than the other because it's got all the modern bells and whistles. The homeowners rates, not being able to use catastrophe models, except for the FAIR plan, seems good enough for thee but not for me, or vice versa, however that works. Or reinsurance costs for auto. You can't consider the two most accurate things in setting automobile insurance prices. The intervener process, which we've talked about, and I think we're just going to keep talking about that one because it's so good. Let's pay somebody to gum up the system and slow it down and make it so that you can't charge the prices that you need. And then we already mentioned the false steamer provision. So all of this would not be so bad, right? It could make premiums not enough in some instances, but the other thing it does is it keeps insurers from operating and doing what they do. So segmentation. I won't keep you in actuarial science class for too long. I am a recovering professor, and sometimes I do this by accident. But the way that insurance companies compete with each other is they try to segment people into large groups, but specific groups where they can charge less money for that group than the other company is charging and still make a profit. And by following that strategy, the consumer who shops for their insurance winds up with the very best price they can possibly get. It's very efficient. If you're not allowed to use all these accurate predictors for setting prices, then you never get that efficiency in your market. And I'm going to show you what happens when your market lacks that efficiency. So this all seems obvious, that Prop 103 is a bad insurance system, but there are people who will tell you that Prop 103 is the very best insurance regulation system you could possibly have. This is a paper by my old buddy J. Bob Hunter and Douglas Heller, insurance expert. I don't see Bob that often anymore. I think he's retired. So they put out this paper and they show that Other states would save $60 billion a year if they just had Prop 103. And what I'm going to show you is that if you dig into the details, you realize that either they're very bad at math or they're not very honest. I'll let you be the judge because I really couldn't tell you which one it is. Having spoken at length with some of these folks, I know that numbers are not their strength. But Bob Hunter's a fellow of the Casualty Actuarial Society, so he should at least be able to do the simple addition, subtraction, multiplication, division. They tell you that because California's insurance premiums only increased from 1989 to 2015 by 12.5%, and everybody else has increased, all the other states increased by 61%, and the comparison in just the liability premium is even more desperate, even more different, that this pattern of premiums shows that everyone else would save money if they just had Prop 103. Well, and by doing this, all of these states, if you just impose those premium patterns, would save this much money, and it turns out to be about $60 billion total that they would save. So if you're intellectually squeamish, you may want to cover your eyes now, because this is kind of like throwing dodgeball at the sumo wrestler, but I'm going to take you through the process of explaining why they are incorrect. Nothing? Dodgeball at the sumo, and that's all? Okay. I came all the way here from Alabama, y'all. That's a 5-hour flight. So, pop quiz. What determines insurance premiums? Is it the premiums themselves determine the premiums, or do insurance losses determine the premiums? I'm going to suggest that it's the losses that determine what the premiums have to be, at least if you want your insurance company to survive. You can't just say, well, we charged this last year, so let's charge this next year and not think about how much you paid out in losses. Your premiums are all about what your losses are. Every empirical model shows that. So this is the losses per car in California from 1987 through 2006, just showing some of the big changes. So what happened in 1991? Royal Globe took away the first party, the Royal Globe case took away the first party direct action to be able to sue your own insurance company for losses or something like that. And so it changed the loss trajectory. The losses per car, and this isn't like real losses, this isn't adjusted for inflation, this is just how much it was. So it was going up, and then the losses came down. Now what part of Prop 103 would make losses change? Prop 103 talks about the premiums and how you calculate premiums. It says absolutely nothing about losses. But what they're taking credit for in their analysis is that the losses went down. This is the ratio of bodily injury to property damage losses in California versus the rest of the country. So think about it. For every property damage loss, that's a chance to have a bodily injury loss. And across the states, what would make it different? You know, we're averaging out across all the people that crash in a state. Why would, if you've got 20 BI claims, bodily injury claims per 100 property damage claims in the rest of the country, say if you're in Nevada, but in California you've got 65. Are the crashes that much worse in California? No, it's that you get that much more when you sue. At least you did before the Globe decision. And so that Globe decision put this trend in place, and since then, the the losses in California have really improved. I was struck with how good it seems drivers are. Maybe you're just stuck in such gridlock traffic that you can't get going fast enough to cause a really good crash. You know, in Alabama, we can really crash. A lot of times we don't have to have anybody to run into, just a telephone pole on the side of a 2-lane road at night, maybe with flashlights and guns, probably a couple beers, but we'll crash those cars for you. Here is California's losses, like I just showed you, and here's the premiums that were charged. So when the losses start going down, and you've got Prop 103, you don't want to reduce your premiums because you know you can't raise them back up when you have to. Why would you ever take a premium reduction if there's no way to compete for business because you can't price people accurately, and you know that you can't raise the prices again when you need to? So this difference, the premiums start out really, really high, and then they go down when interest rates increase, just the way they're supposed to. They come back up, and they're saying because this and this are similar, this is the best regulatory system you can have. But looky here. The losses, it has nothing to do with Prop 103. Yes?
It's my understanding that Garamendi froze auto insurance rates when he was commissioner in the early 90s. And so that would suggest that insurance rates might have gone down.
They could have. Well, certainly. Yes, a rate freeze would not let them go up or down. I am aware of exactly 2 times that an insurance company has filed a rate decrease and had it rejected. One of them was in California in the late 80s. And the other one was the company I used to run in Arkansas because the commissioner didn't like us. But I've looked for another one and I can't find it anywhere. So here we impose the rest of the country on this. And what you see is that once you get past 96, 97, then the behaviors between, so the losses per car in California look really good compared to the rest of the country. The premiums are still a little bit higher, but you see that the premiums start out a lot lower. So they're saying that because this premium went from here to here instead of here to here, that's bad. Well, they're saying it's just the premiums in the rest of the country started out where they should be, very low, and then increased over time, and California's were already very high and stayed the same. There's no $60 billion to be had. This is just stretching that out to 2019, and I think the next slide is the one that's really good. So this is the ratio of premiums to losses. This is premiums per dollar of loss that's paid. The red line is California, and the black line is the rest of the country, excluding California. And you can see that the difference between premiums and losses is it's almost always quite a bit higher in California than everywhere else. Are you making money? Maybe on average there's some money being made, but you're not able to compete for that. You're not able to get the losses that you want, so you still don't want to participate. This is what Prop 103 is doing for you. It keeps the prices from going where they need to be. So the average in California is like 2 point something versus 1.9, 1.85 in the rest of the country. So the way we can actually determine what would happen if you had Prop 103 everywhere or if you had reasonable insurance regulation in California is instead of using counterfactual premiums based on the premiums themselves, we do counterfactual premiums based on losses. So we divide premiums by losses, multiply it for the rest of the U.S. and multiply that times the losses in California to get this counterfactual premium in California, and then we do the opposite for the rest of the losses in the country. And what we come up with is that based on this reasonable analysis, if other states had had Prop 103, they would have paid an additional $218 billion since 1989. They would not have saved $60 billion. They would have paid an additional $218 billion, whereas if California had had the same insurance regulation as the rest of the country, they would have saved $25 billion since 1989. Very simple math. Very straightforward analysis, and that's what we find. And on top of all this, you've paid interveners more than $24 million to make sure you're getting the best deal, to keep Californians' insurance rates low. You've paid these people $24 million, about $1 million a year you're paying to have them oversee this process. Who thinks we should keep doing that? I think there's a pretty good argument to be made that this is the wrong direction. I know it's a difficult ship to turn, but I can't think of one good reason to keep this. I can think of a lot of good reasons to change this. And I think that's what we're going to hear about next, is how we could do it. Thank you.
Well, gee whiz, Harvey's looking out for us. Thank you, Lars.
Pleasure.
And then our final session this morning, Sam Sorich, come aboard.
Got it? Okay. This is from the second section of Proposition 103. The second section of Proposition 103 sets forth the proposition's purposes. The section states that the purpose of Proposition 103 is to encourage a competitive insurance marketplace, to ensure that insurance is fair, available, and affordable. Karl, Christian, and Lars have shown that Proposition 103 has not achieved those purposes. Karl described how the administration of Proposition 103 has discouraged competition and forced insurance companies to limit their businesses and even exit the California market. Lars demonstrated that Prop 103 has not been fair to consumers and explained how the proposition forced consumers to pay billions more than they should have been paying. And Christian showed how Proposition 103 has made insurance coverage unavailable and unaffordable for thousands of California homeowners and forced them to go to the FAIR Plan for inadequate coverage. Proposition 103 has failed to achieve its purposes. Proposition 103 has broken the promise it made to voters, and Proposition 103 should be reformed or repealed. Oop. I will do three things. I'll discuss three issues. First, the history of Proposition 103. Two, the four provisions in Proposition 103 that have caused the current crisis, and how the four provisions can be changed. Now, nearly half of Californians today were not even born when Proposition 103 was passed 37 years ago. So maybe it's a good idea to give a little history. It was a dark, cold night on November 8, 1988. The 1988 election was an ordeal for voters. In addition to voting for president and numerous local officials, California voters were asked to vote on a bewildering 29 propositions. 5 of the propositions were aimed at, as you've heard, California's auto insurance crisis. 2 issues converged to create the auto insurance crisis. First, back in 1986, the legislature passed a law that required drivers to carry proof of insurance in their cars. Now, before that, drivers had to buy car insurance, but there was no primary enforcement. The 1986 law required drivers to carry proof of insurance in their cars, and many drivers did not like the idea. And second, as Lars mentioned, there was a court case that expanded the number of lawsuits that could be filed against auto insurers. So those two issues came together to create the crisis. When drivers went to the polls in 1988, they were angry. They had to buy insurance, and they had to pay for auto insurance premiums that were skyrocketing. Proposition 103 seemed like a good idea. It promised a competitive insurance market, rates that were fair, and insurance that was available and affordable. In addition, Proposition 103 promised consumers that all their insurance premiums would be reduced by 20%. That sounded good too. Proposition 103 seemed like a good deal for voters when they went to the poll 37 years ago. As the ballots were being counted, and that's the way we used to count ballots back in 1988. When the ballots were being counted on that stormy night, it became clear that Proposition 103 was the only one of the 5 insurance initiatives that was going to be approved. As you heard, Proposition 103 received 51% of the vote, despite the fact it only received a majority in 6 counties. It is unlikely that many voters read the 10 pages of small type on Proposition 103 in the 160-page voter pamphlet. Well, the backers of Proposition 103 were celebrating. Californians started to discover what Proposition 103 said. One revelation, as you've heard, is that the proposition was not confined to auto insurance. It applied to many property casualty insurance lines, including homeowners, surety, commercial property, and many others. There are, I think that's, I'm sorry, that's out of order. We'll go ahead. Anyways, there are 14 major provisions in Proposition 103. I could break them down into 4 categories. The first category are provisions that the California Supreme Court struck down 6 months after Proposition 103 was voted. One provision, as you heard, reduced rates by 20%. The only way a company could escape the requirement to reduce its rates by 20% was that the company could show that that rate would result in solvency. The California Supreme Court struck down the solvency provision but retained the rate rollback. And the second provision was that the proposition contained a provision that would have created a consumer advocacy corporation, and the court struck that provision down also. The second category are a number of changes which really haven't affected insurance operations. First, the proposition did away with insurers' exemption from some antitrust laws. Companies never really had to change their operations because of that. The proposition also made insurers subject to the Unruh Civil Rights Act, but insurers were already following that law. The proposition required the Department of Insurance to create a comparison of rates, which they're still doing, but I don't think anybody pays attention to it. Fourth, the proposition repealed California's prohibition against agent rebates, and rebates really are not at issue today. And the proposition also authorized insurers to issue insurance coverage on a group plan. And in fact, that's a provision which is helping companies provide discounts. The third category are provisions that undermine risk-based pricing and sound insurance underwriting. Proposition 103 requires an auto insurer to renew